Welcome. Hello and welcome. ETFs are all over the place. Everyone, including me, is investing their money into ETFs. From a rational perspective, totally makes sense as you're getting a potentially higher return for less costs. Why is that? You invest in a passively managed product. So an ETF is just mirroring a certain index such as the S&P 500. Opposed to that, you have actively managed products. So actively managed funds, which have a fund manager who's making stock pick decisions, who's managing the fund, and you have to compensate him for that. So it's more expensive to get an actively managed fund. On top of that, research, both academic and institutional, has shown that ETFs even outperform the vast majority of actively managed funds. So you have a win-win situation for private investors and also institutional investors to invest into ETFs because potentially they perform better over the long term and they also cost less. That's why the ETF market is huge. And this market has a lot of interesting data related to that. And in this video, we are going to take a look at some of the biggest ETFs in the world. We're taking a look at all kinds of markets, all kinds of sectors, all kinds of global diversities. And what we are going to answer in this video is if it makes sense to combine ETFs to even optimize around the ETF selection. So there are already some, let's say, theories of investors or people who say, okay, you have to take 60% of your investments and put that into the MSCI World and 40% into emerging markets. Or you have to take 70% into the S&P 500 and 30% into treasury bond ETFs. So they're already circling around some combinations of ETFs which are supposed to optimize your ETF portfolio. And this is what this video is about. We are putting some data into perspective and take a look at ETFs. We're going to start very simple. So we're just taking a look at which were the top performing ETFs across a range of ETFs. And then we are going into the interesting part of this video where we are optimizing based on the risk-adjusted return or Sharpe Ratio and take a look at if you make a trading decision based on something which happened in the past. So let's say 2023. And based on that decision, apply it to 2024 without seeing the 2024 data, if that trading decision would have been a good idea looking back. But without having the data, so you don't have a forward-looking bias. So this video, as said, is going to be very interesting. So let's get into it. So first of all, we need a couple of libraries. Y-Finance to pull financial data for the ETFs, then NumPy for some calculation stuff, Pandas for data handling, and then Minimize from SciPy to run our optimization in the end of this video. So these are the libraries, and that is a list of ETFs I have browsed. So let's go through some of them, starting with probably the most popular one besides the MSCI World. We have the SPY, which is an S&P 500 one, so large cap US equities. Then we have Russell 2K, for instance, FTSE All World. We got emerging markets, we got international equity, we got Japan, we got Canada, some bond ETF, some emerging markets, some high yield corporate bonds, real estate, gold, silver, oil, innovation, clean energy, some sector-specific ETFs. So a good range. So we have our dear Brazilians here, Indian people, or ETFs. China or Harvest China, so China equities. We got agriculture here. So a huge range of different sectors, different global markets. And I think this is going to be beyond interesting to get some data insights to those ETFs. Starting easily, so let's execute that. We have a list of ETF tickers. So let's take a look at how that is looking like. So you see, we just have a list containing those tickers for the ETFs, and I have some comments here so that we know what these ETFs are actually about. You can also pull that via the Y-Finance API if that is more convenient for you. So this list we pass to Y-Finance to get the prices for those ETFs. So that is what I'm doing here. So I'm pulling data, pick the Y-Finance download function, then pass the ETF tickers list. And I'm starting in 2022 here. So you can analyze whatever time horizon you're interested in. Just keeping it simple here, pulling data for the last years. Then, very important, I'm only pulling the close column. Now, if you use the most recent version of Y-Finance, this is going to be the adjusted close column, as they made some amendments to the library. If you use the old version of the package, you have to pull the adjusted close column here. So this is the adjusted close. They just named it as close column. So let's take a look at what we're getting here. So this is just a data frame containing all the ETF tickers and price data starting in 2022 going until the last available trading date here. So nothing too complex for now, just daily price data for all the ETFs. And now we want to analyze them and take a look at the performance metrics of those ETFs. So this is what we are going to do in this function. So let me quickly guide you through how this function is working. So calc performance is taking a price data frame and a certain year. So you want to take a look at the performance for a given year. So I'm putting that to 2023 by default here. And this function is just filtering the price data frame for that given year. So you just have the price data for 2023. And then you calculate the daily returns by applying the PCT change function. So instead of the absolute prices, you get the relative changes. So I can show you how this would look like in a nutshell. So you see you get daily returns instead of those prices. So you can actually compare those ETFs because you take a look at the relative price change and not the absolute price change. Then you take the returns, take the daily returns, and then the mean of that. So you get the mean daily return with that for all those ETFs. You can annualize those returns. I would be cautious with that because we are going to the optimization later on, and this is making stuff a bit more complicated. So I recommend to just leave it out, but if you want to have it in, feel free to amend the code, but be careful in the optimization later on. So we got the volatility. This is just the daily returns standard deviation. And then we have the Sharpe Ratio, which is just the return divided by the volatility. Side note, yes, the risk-free rate is missing. You can add it if you want. I'm just keeping it out for simplicity reasons here. So return in relation to volatility is with Sharpe Ratio. And then in the end, I'm also calculating the cumulative return. This is just the overall return of a certain ETF over a given year. So you just add a 1 to that, take the product and subtract the 1. It's simple return accumulation, which I'm doing here. Then I'm creating a data frame, which is just containing a return column, which is the return. I had annualized returns here in, so that is obviously wrong. I put them out because they were causing issues in the optimization later on, so I decided to keep it simple and take the mean, the daily mean return here. So these variable names were still wrong here. Sorry for that. So we have the return, the daily return, the mean daily return. We have the volatility of daily returns. We have the Sharpe Ratio and the cumulative return in our data frame. So if I'm calling this function calc performance here and pull that for our data and actually take 2023, this will provide us a data frame like this. Super interesting. You have a return column. This is the mean return, the mean volatility, the Sharpe Ratio, and the cumulative return. So let's take a look at, for instance, before doing that, let's actually take a look at what we see here. So ARK, this is a very popular ETF covering innovation stocks. I think biggest position is Tesla at the moment. And this one's investing in innovation stuff. So AI, payments, blah, 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 and so on. And this one has quite a big average return here, as you see, and also quite a high volatility. and a cumulative return of 73%. Think about that, 70%, 73% within 1 year. So this is going to be an interesting one. And then we have another one here, for instance, this one, which on average didn't perform, so it has a negative mean return, and you already see that reflected in the cumulative return. So this one was losing 14% with still a high volatility. So you see, high volatility doesn't necessarily mean high return. It can also go in the other direction. People forget about that. Now, if you want to sort that by the return, you could apply something like this. So you take the n largest on the, let's sort that by return, then take the top 5 of that. So you see you're getting the top 5 returns here, which is ARK, SOX. What is that about? Don't know that. Semiconductor, okay, makes totally sense. And we have these insane cumulative returns and also daily average returns of 73% and 68% here for those ETFs. And that brings us to the first, let's say, naive trading strategy. You could just say, okay, I'm taking a look at the performance over the last year, and then I pick the best performing ETFs, and I just buy them, hold them for the next year and see how that is turning out. And this is what you can super fastly just see here by pulling only the year 2024 and take a look at the top performers of this year and see if those stocks would have been in there. So let's say you decided on ARK. So you said, okay, this one was such a crazy year for ARK, it will continue in the next year. So you decide to just all in on ARK. So how would that turn out in 2024? Not a bad decision, to be honest. You would have made 12.4% on ARK, and that would have been your strategy for 2024. But if you would have invested in the S&P instead, which was also in your top stocks, you would have made 26%. So it wouldn't necessarily be the best decision to go into ARK here overall. Now, you could also, this would also be a more, a quite naive strategy, but a more informed decision, as this is the risk-adjusted return. So you want to sort by the Sharpe ratio. By the way, as a side note, this is also how a lot of trading algorithms make decisions, and also how a lot of portfolio allocation algorithms decide based on the risk-adjusted return. So let's say what that would have been. So if you sort by Sharpe ratio, you would have gotten SOX here as your best horse here. So you would have get 0.12 Sharpe ratio. This would have made 68% in 2023. And let's take a look at how that would turn out if you would have bought that in the beginning of 2024. So with SOX, you would have made 17%. So a decision based on the Sharpe ratio is a bad idea. And you see that the SPY would have made 26%. And now the question, and this is, so you can do way more analysis here if you want. You can take a look at the highest vola. Let's actually do that. It's a funny thing to do. So let's say we are buying based on the highest vola. We are risk lovers. So ARK, we played that through, but we have PBW. So this one made 18% losses. Let's say you just want to bet on that one. What is that actually? PBW is, okay, clean energy, not the best year for that in 2023. So PBW would have made, I think we have to pull all those because this is probably one of the worst. Yeah, this would have made 29% loss in the follow-up year. So a decision based on vola, at least on ETFs, doesn't seem to be the best decision. But we don't know for sure yet. So let's move over to some optimization stuff. So before doing that, the idea now, just to give you perspective, what we want to achieve here. So it could be that a combination of multiple ETFs would give us our best trading decision. And as we know that Sharpe Ratio is a good idea to optimize on, we optimize on the best Sharpe Ratio of a combined portfolio. So what we are essentially doing is we run a minimization on a negative Sharpe Ratio. So we just flip the sign of the Sharpe Ratio and find the minimum of the best combination of stocks. So we are optimizing the so-called weights of the portfolio subject to the Sharpe Ratio. Simple example. You have a portfolio of, let's take 3 ETFs. Now you want to know what percentage of one ETF you want to buy. So is it 20%, 20%, 60%? Is it equal weighted? So 33, 33, 33? Is it maybe 5, 15, 80? This is what we want to find out. So this is what we are going to design here. By the way, you can also, the sky's the limit here, right? You can also do some other fancy stuff, like you want to buy the top 3 Vola stocks. You want to buy the top 3 Sharpe Ratios with a weight X, or you just have an idea in your mind. So for instance, you want to test the 60% MSCI, 40% emerging markets strategy based on 2023 data and apply it to 2024 and see how that is turning out. But we are moving on to the optimization for now, as I think this is the most interesting part. So I set it up here and I will guide you through how exactly this is working. So first of all, you just filter the data again for the year 2023. Simple background here, I'm running the optimization based on 2023 data, and the idea is then to invest in the beginning of 2024 and see if that optimization would have made sense looking at that time horizon. So I don't want to see any data in 2024. I just want to make my decision based on data for 2023, and then I apply the optimized weights in 2024 and see how that portfolio would have performed. So it's going to be extremely interesting. So 2023 data we have, and then we just calculate daily returns with the PCT change function, take a look at the mean return and the covariance metrics on those returns. And then, as I said, this is our optimization subject. So this is the function which returns the flipped Sharpe Ratio. So just as a background, the higher the Sharpe Ratio, the better, right? Makes sense because you want to have a high return and a low volatility. So the risk-adjusted return is the best if the Sharpe Ratio is higher, because it means that either the return is higher or the vola is so low that it turns the value into a higher value. Simple math here. So we got the Sharpe Ratio function, and this is taking an array of weights, the mean returns, and the covariance metrics. And the portfolio return is super straightforward. This is simple to explain. You just take the mean returns and take the dot product with weights. So simple example, you have a portfolio of, let's just take 2 ETFs, 50% weighted. So your weights array is looking like that 50% and 50%. And then you just take the dot product of this 50% with the mean return of the assets. So you just weight your returns by how much of the assets you were buying. So 50% times return plus 50% times return. Simple as that. And with that, you've calculated your portfolio return. Obviously, also works with other weights. So let's say you have 20% ETF 1, 80% ETF 2. So it's 20% times return plus 80% times return. And with that, you have your portfolio return. Simple as that. That is not so easy to explain in mathematical terms. This is just, so what I'm marking here is just the portfolio variance. I've explained that in detail in my Python for Finance course, so I've designed certain slides of how exactly the mathematical operations are working, so be sure to check that out if you haven't done that. I've also covered that in some of my previous videos. In a nutshell, you just take the covariance matrix, take the dot product with the weights, and then again take the dot products with the weights again. Why exactly you are doing that is simple if you do the operation in your head or by hand, draw it down. As said, I've covered that in other sources, both in my course and on my channel. Once you get the portfolio variance, you just take the square root out of the variance, and with that you have your portfolio standard deviation or portfolio volatility. Simple as that. Then the Sharpe ratio, same story as before, return divided by the portfolio volatility, and then you just return the flipped Sharpe ratio, as we want to maximize the Sharpe ratio and we can only minimize with the SciPy package. You need a couple of constraints. This is super straightforward, looks a bit cryptic, but this is just the easiest thing to explain. So this constraint is simply making sure that your weights array is always summing up to 1. Meaning you have 2 ETFs, 20% first, 80% second. This is summing up to 1 or 100%. You have, let's take 50-50, summing up to 1. You have a 3 ETF portfolio, 33, 33, 33, summing up to 1. This is what this constraint is doing. And how does it do it? It's taking an equality constraint, and this is checking for a value being the exact same as 0. And if it's different from 0, it doesn't work. So this constraint is just making sure that the sum of the weights minus 1 is always 0. And that is the case when the weights sum up to 1, which should always be the case. Otherwise, something is going wrong. And this one is even easier. This is just making sure that you have no short selling. So you just want to have values between 0 and 1. So you don't want to have some negative weight. This one even easier than that, gets easier with every line here, luckily. So this is just setting the initial weights, and the assumption for the initial weights is equal weight. So you pass all ETFs tickers and pass equal weights to that. And what are the equal weights? Mathematically super easy. I'm just showing it how this is working. Just create an array of ones. And this is an array of ones with the length or with the shape of the ETF tickers, which are 30 as you saw above. And you just get ones, so 30 ones here. And you just divide that by the length again of ETF tickers. And with that, you're getting equal weights. All right. So initially you set the weights to just 3.3% for all of those assets. This is where you start the optimization. So just to give you an even simpler example, if you have the 2 ETF case, you just start with 50% each, right? 3, 30% each, and so on. So super straightforward. This is just what the initial weights is doing, assigning equal weights. Next, you run the minimization. So minimize, then pass the function you have created. So you want to base the minimization on, that is the negative Sharpe ratio. Then the initial guess you have, then the arguments, which are the mean return and the covariance matrix. Then a method optional, that is SLSQP by default, but doesn't hurt to define it here as well. Then you also add the bounds and constraint we defined above. And with that, you have successfully created a minimization based on the Sharpe ratio. The optimal weights then will be the result, and this is just accessing the X element, which is just containing the optimal weights array. And then it's super straightforward. You just take the optimal weights and multiply it with the mean return, and then again just add it up to get the portfolio return based on those optimized weights. Same story for the volatility, same story here again, same calculation. So just the simple, or the maybe not so simple if you see it the first time, portfolio standard deviation calculation based on the optimal weights arrays. This and this. Finally, the optimal Sharpe ratio, same story, return divided by the volatility. And this is just that we see the optimal weight. So this is just, this is optional. You don't necessarily have to do that. This is just that we see what ETF tickers have what optimal weight. So that we see the selection out of curiosity. And then in the end, you just print out stuff. So portfolio return, the volatility, and the Sharpe ratio. So let's run this, and this is going to be interesting. So based on 2023 data, we get the following assignments here on the portfolio. So it's suggesting us to get into 18%, 13% GLD. That's probably a gold ETF. That would have made a lot of sense if you take a look at the gold price over the last month / years. Then EMB, I don't know what that is, TIP, and EFA. Let's actually check that out. So TIP, EMB, EFA. What are they about? TIP is, okay, it's a bond ETF. What else did we have? EFA, developed markets, excluding US and Canada. Also an interesting one. And what was the last one? What was it? DBA? Agriculture Fund? Or did I read it wrong here? EFA, GLD, EMB. EMB, sorry, I read that wrong. Okay, emerging markets, interesting. That is assigning, that is supporting the theory that you have to mix it in for some reason. At least it's an indication to that. And then we have the Schwab International Equity. So quite an interesting distribution we get suggested here. And this is then mean return of 0.11%. So this is a bit, I should have designed that in a different way here. I should have shown you the cumulative return. This is a bit hard to read. But anyhow, I will show you it more clearly in the next step. So we have a volatility of this and an optimal Sharpe ratio of this. Doesn't matter for now, because this is just the optimization. In the end, we just need the optimal weights, which you saw here. And now, next step, we are just doing the testing based on these optimal weights. Meaning, we create training data. So this is just machine learning terms on the data we run the optimization on, and then testing is the data we didn't see yet, and we test to see if the data we trained on is applicable to 2024, nothing more than that. So we just create training data based on 2023, where the optimization is based on, and 2024, where we apply the optimized weights. And then I'm just creating training daily returns by taking the percentage change on the training data, then on the testing data, and then super straightforward, just take the portfolio daily returns by the dot product of the train daily returns and the optimal weights, and then the cumulative return. And this is what I just referred to. So this is rather the cumulative return based on those weights. And then I'm getting the testing. This is the more relevant part. This is now the dot product of the optimal weights based on 2023 on the test data on 2024. So this will actually tell us if our decision to take those weights based on 2023 makes sense in 2024. Then the cumulative return on testing, this is going to be super interesting, is the same story here. So just the cumulative testing portfolio daily returns. All right, so let's run this. So you see, obviously, I'm just printing out stuff here. So the cumulative return on training and testing, and then also the Sharpe ratio on both. So let's run this. And this is our training performance, and this is our testing performance here. So you see, this is the same as we got above. So this Sharpe ratio will be very similar to the optimization Sharpe ratio. They're printed out. Yeah, optimal Sharpe ratio 0.5. Obviously, this is going to be the same. This is just the 2023 data. So we would have made 32% on this ETF distribution with Sharpe ratio of 0.15. That doesn't tell us anything because this is just the time period we were running this optimization on. This is the more relevant part because this is telling you what the performance of the portfolio would have been based on that optimization. So you are at the end of 2023 and make a decision, hey, these ETFs I want to buy with these percentages based on my 2023 optimization. Then you, at the end of 2024, you sit down and see, okay, how did my portfolio perform? And this, so it made 15% here. This is how you read it with a Sharpe ratio of 0.07. Well, let's bring that a bit into context with the other performances in 2024 to see if that would have made sense here. So let's take the top 10 returns here and see if we can rank that somewhere. So if we have a total return of 15%, we have to take a look at this column here. Let's actually take a look at the cumulative return. So we have it somewhere, so 15% somewhere between those possibly, right? And those, let's take a look at bots here, which has a slightly higher return than our optimized portfolio, would have had a smaller Sharpe ratio. And with that, it has to have a higher volatility. So I should have printed out the volatility as well, that we can better perform, but you can do that. So I'm not boosting the time of this video's length anymore, but you see that this portfolio would have been a quite good trading decision. And I think this is quite interesting to see. So yeah, play a bit around with that. Let me know your insights. I hope you found this as interesting as I found this. And yeah, I'm looking forward to seeing your upcoming videos. Cheers. Bye.